Question 7. What are the risks associated with SVOL? The Simplify Volatility Premium ETF, SVOL, carries various risks that investors need to carefully consider before investing. While offering potential benefits like income generation and downside protection, these benefits are not guaranteed and come with inherent uncertainties. Here's a breakdown of the key risks associated with SVOL. 1. Market volatility. While SVOL aims to capitalize on volatility, it is also vulnerable to its negative effects. If market volatility decreases significantly, SVOL might generate lower premium income, potentially impacting its returns. Conversely, extreme market volatility can lead to larger losses if the underlying assets experience significant price movements outside SVOL's options strategies. 2. Option risks. SVOL's reliance on option strategies exposes it to inherent risks associated with options. These include O-directional risk. If the market moves in an unexpected direction, SVOL might experience losses. For instance, if the SPX price falls below the strike price of sold put options, SVOL might be obligated to buy the index at a higher price than the current market value, incurring a loss. O time decay. As options approach their expiration date, their time value diminishes, potentially leading to losses even if the underlying asset price remains unchanged. O implied volatility risk. SVOL strategies rely on implied volatility, which is the market's expectation of future volatility. If the actual volatility deviates significantly from the implied volatility, SVOL's performance can be impacted. 3. Active management risk. Unlike passively managed ETFs, SVOL relies on the skill and judgment of the fund manager to select and manage the option positions strategically. The manager's decisions significantly impact the fund's performance. Poor investment decisions or unforeseen market events can lead to losses for investors. 4. Fees. SVOL has an expense ratio of 0.5%, which is slightly higher than some passively managed ETFs. These fees can eat into potential returns, and investors need to consider the cost-benefit relationship before investing. 5. Counterparty risk. SVOL's option strategies involve counterparties, e.g., the option buyers. If a counterparty defaults on their obligations, it can negatively impact SVOL's performance and potentially lead to losses for investors. 6. Liquidity risk. While SVOL trades on a major exchange, NYSE Arca, its trading volume might be lower compared to some widely traded ETFs. This can lead to liquidity risk, making it potentially challenging to buy or sell shares at the desired price, especially during periods of significant market volatility. 7. Tax considerations. The income generated by SVOL through option premiums might be subject to different tax treatment compared to traditional investments like dividends or capital gains. Investors need to consult tax advisors to understand the potential tax implications of investing in SVOL and how it might impact their overall tax liability. Question 8. Is SVOL suitable for all investors? No, SVOL is not suitable for all investors. While it offers potential benefits like income generation and downside protection, it also carries significant risks that some investors might not be able to tolerate. Here's why SVOL might not be a good fit for everyone. 1. Risk aversion. Investors with a low risk tolerance should generally avoid SVOL. The inherent risks associated with market volatility, option strategies, active management, and other factors can lead to substantial losses that might not be suitable for individuals with a conservative investment approach. 2. Lack of investment knowledge. SVOL requires a fundamental understanding of options and their associated risks. Investors unfamiliar with options or lacking the time and resources to research and understand the complexities of SVOL strategies might be better suited for simpler investment vehicles with lower risk profiles. 3. Short-term investment horizon. SVOL is not ideal for short-term investment horizons. Option strategies can be sensitive to short-term market movements, and SVOL's performance might not be consistent over brief periods. Investors with short-term investment goals might be better off with less volatile investment options. 4. Limited investment experience. Investors with limited investment experience, or a lack of knowledge about actively managed funds, might struggle to properly evaluate SVOL and its suitability for their portfolio. Consulting a financial advisor can be crucial for such individuals to gain a deeper understanding of the risks and potential benefits associated with SVOL. 5. Inability to handle fees. SVOL's expense ratio of 0.5% is slightly higher than some passively managed ETFs. Investors who are highly cost-conscious or prioritize minimizing fees might find other investment options more appealing. Alternatively, SVOL might be suitable for income-seeking investors. For individuals seeking regular income, SVOL's monthly distributions can be attractive. However, it's crucial to remember that these distributions are not guaranteed and can fluctuate based on market conditions. Sophisticated investors, investors with a strong understanding of options, risk tolerance for volatile markets, and a long-term investment horizon might potentially benefit from including SVOL in their portfolios as a diversification tool. Question 9. In what investment scenarios might SVOL ETF be suitable? The Simplify Volatility Premium ETF, SVOL, could be a suitable investment option in certain scenarios, but careful consideration of its unique characteristics and risks is essential before making any investment decisions. Here are some potential scenarios where SVOL might be considered, but remember, these are for informational purposes only and do not constitute financial advice. 1. Income-seeking portfolio with long-term horizon. Investors seeking regular income and willing to accept increased volatility in exchange for potential higher returns compared to traditional income-generating options might consider SVOL. The monthly distributions from option premiums can contribute to a consistent income stream, but remember, these distributions are not guaranteed and can fluctuate based on market conditions. However, a long-term investment horizon is crucial, as SVOL's performance might be volatile in the short term, and investors need sufficient time to potentially weather market fluctuations and benefit from its long-term strategy. 2. Diversification strategy with risk tolerance. Investors seeking to diversify their portfolios and add exposure to an asset class with low correlation to traditional stocks and bonds might consider SVOL. Its potential to benefit from market volatility can offer a hedging effect against broader market downturns, potentially mitigating overall portfolio risk. However, this does not guarantee protection against losses. Investors need to possess a high level of risk tolerance as SVOL is exposed to various risks, including option strategies, active management, and market volatility. 3. Advanced investors with options knowledge. Sophisticated investors with a deep understanding of options and their intricacies might consider incorporating SVOL into their portfolios as a strategic investment. Their knowledge allows them to better assess the potential benefits and risks associated with SVOL's options-based strategy. However, even for experienced investors, thorough research and careful consideration are crucial before investing, and it's always recommended to consult a financial advisor for personalized guidance. Question 10. How does SVOL compare to other volatility-related strategies? The Simplify Volatility Premium ETF, SVOL, presents a unique approach to capturing the volatility premium, but it's important to compare it to other volatility-related strategies to understand its relative strengths and weaknesses. Here's a breakdown of how SVOL stacks up against some alternatives. 1. Futures-based strategies. Similarities. Both SVOL and some futures-based strategies aim to benefit from market volatility. These strategies can involve using volatility futures contracts, or exchange-traded funds, ETFs, that track volatility indices. Differences. Complexity. Futures-based strategies can be more complex to understand and implement compared to SVOL, which utilizes a more transparent option-based approach. Costs. Futures contracts often involve higher margin requirements and potential roll costs compared to SVOL's expense ratio. Accessibility. SVOL is readily available through brokerage accounts, while some futures-based strategies might require opening a futures account with a specific broker. 2. Managed futures funds. Similarities. Both SVOL and some managed futures funds are actively managed and aim to profit from market movements, including periods of volatility. Differences. Investment approach. Managed futures funds can employ a wider range of strategies beyond just capturing volatility, such as trend following or global macro. This can offer greater diversification, but also introduces additional layers of complexity. Fees. Managed futures funds typically have higher fees compared to SVOL's expense ratio. Minimum investment. Managed futures funds often have higher minimum investment requirements compared to SVOL, making them less accessible to smaller investors. 3. Inverse ETFs. Similarities. Both SVOL and some inverse ETFs aim to profit from market downturns. However, their approaches differ significantly. Differences. Mechanism. Inverse ETFs use various mechanisms to deliver the opposite return of an underlying index or asset class. This can be achieved through inverse weighting, shorting the underlying, or using derivatives. Risk profile. While SVOL aims to benefit from increased volatility regardless of the market direction, inverse ETFs are specifically designed to profit from falling markets, making them inherently riskier. Limited upside. Inverse ETFs typically offer limited upside potential in rising markets, while SVOL can still potentially generate income through option premiums even in flat, or slightly positive market environments. 4. SVOL Volatility Index, VIX, products. Similarities. Both SVOL and VIX-related products, such as futures contracts or ETFs, aim to capture volatility. The VIX is a popular volatility index that reflects market expectations of future volatility in the S&P 500. Differences. Underlying exposure. SVOL focuses on capturing the volatility premium through option strategies, while VIX products directly track the VIX index itself, which reflects anticipated volatility rather than actual market movements. Complexity. VIX products can be even more complex than SVOL, as they involve factors like contango, a situation where futures prices are higher than the expected spot price, and backwardation, the opposite of contango. Accessibility. Similar to futures-based strategies, some VIX products might require opening a futures account. Question 11. How does the performance of SVOL compare to traditional investments? Comparing the performance of SVOL to traditional investments like stocks and bonds requires a nuanced approach, considering their fundamental differences in investment objectives, risk profiles, and historical performance patterns. Investment objectives. Traditional investments primarily aim for capital appreciation through holding assets like stocks and bonds over the long term. SVOL focuses on capturing the volatility premium by employing option strategies, aiming to generate income and potentially enhanced returns even in volatile markets. Risk profiles. Traditional investments generally carry a moderate risk profile, with varying degrees of risk depending on the specific asset class, e.g., stocks are typically considered riskier than bonds. SVOL carries a higher risk profile compared to many traditional investments due to its inherent exposure to market volatility, option risks, active management risk, and other factors. Historical performance. Traditional investments. Historically, stocks have delivered higher average returns than bonds over the long term, but also come with greater volatility. Bonds typically offer lower average returns, but with lower volatility, and can provide a source of income through regular coupon payments. SVOL is a relatively new ETF, launched in 2018, and its historical track record is still limited. While it has the potential to outperform traditional investments in volatile markets, it might underperform in calm or rising markets due to the costs associated with its option strategies and the potential for limited upside potential. Comparing performance. Directly comparing the performance of SVOL to traditional investments, like a single stock or bond index, wouldn't be an accurate representation due to their fundamental differences. However, we can consider broader comparisons. Against the S&P 500, over the limited period since its inception, SVOL has shown similar volatility to the S&P 500, but with lower average returns. However, SVOL also offers the potential benefit of monthly income generation through option premiums, which the S&P 500 does not. Against a balanced portfolio, SVOL might potentially outperform a balanced portfolio, containing both stocks and bonds, during periods of significant market volatility. However, in calmer markets or rising markets, a balanced portfolio might outperform SVOL due to SVOL's potential for limited upside and the associated costs of its options strategies. Key takeaways. SVOL's performance is not directly comparable to traditional investments due to their differing objectives and risk profiles. While SVOL has the potential to outperform in volatile markets, it might underperform in calmer markets compared to traditional investments. SVOL offers the potential benefit of monthly income generation, which is not typically present in traditional stock and bond investments. Question 12. Can SVOL be effectively integrated into various portfolio construction strategies? The potential integration of SVOL, Simplify Volatility Premium ETF, into various portfolio construction strategies depends heavily on individual circumstances and investment goals. Here's a breakdown of its potential role in different portfolios. 1. Income-focused portfolios. Potential benefits. SVOL's monthly income generation through option premiums can be attractive for investors seeking regular income. This can be particularly relevant for retirees or individuals relying on investment income to supplement their regular income streams. Considerations. SVOL's income generation is not guaranteed and can fluctuate based on market conditions. Additionally, its higher risk profile compared to traditional income-generating assets like bonds needs careful consideration. 2. Diversification strategies. Potential benefits. SVOL's low correlation with traditional asset classes like stocks and bonds can contribute to portfolio diversification. This means that SVOL might not move in tandem with the broader market, potentially offering a hedging effect and mitigating overall portfolio risk during periods of market volatility. Considerations. While SVOL can offer diversification benefits, its inherent volatility can also increase overall portfolio risk if not carefully integrated. Understanding the risks and potential impact on the overall portfolio is crucial. 3. Tactical asset allocation strategies. Potential benefits. Some investors employing tactical asset allocation strategies might consider SVOL as a tactical allocation during periods when market volatility is expected to increase. This can potentially enhance returns if such volatility materializes. Considerations. Accurately predicting market volatility is challenging, and SVOL might underperform in calm or rising markets. Additionally, frequent buying and selling of SVOL within a tactical allocation strategy can increase transaction costs. 4. Long-term growth portfolios. Potential benefits. In highly volatile markets, SVOL might potentially outperform traditional long-term growth portfolios. Additionally, its income generation can potentially compound over time and contribute to overall portfolio growth. Considerations. SVOL's historical track record is limited, and its long-term performance compared to traditional growth strategies remains uncertain. Additionally, its higher risk profile needs careful consideration within a long-term growth strategy. Question 13. What are some important considerations before investing in SVOL? Before investing in SVOL, here are some crucial considerations to help you make an informed decision. Understanding the risks. Market volatility. While SVOL aims to capitalize on volatility, it is also vulnerable to its negative effects. Lower market volatility can lead to lower premium income and potentially impact returns. Conversely, extreme volatility can result in larger losses if the underlying assets experience significant price movements outside SVOL strategies. Option risks. SVOL relies on option strategies, which carry inherent risks. Directional risk. If the market moves in an unexpected direction, SVOL might experience losses. Time decay. As options approach their expiration date, their time value diminishes, potentially leading to losses even if the underlying asset price remains unchanged. Implied volatility risk. SVOL strategies rely on implied volatility, which is the market's expectation of future volatility. If the actual volatility deviates significantly from the implied volatility, SVOL's performance can be impacted. Active management risk. Unlike passively managed ETFs, SVOL relies on the skill and judgment of the fund manager. The manager's decisions significantly impact the fund's performance. Poor investment decisions or unforeseen market events can lead to losses for investors. Fees and costs. Expense ratio. SVOL has an expense ratio of 0.5%, which is slightly higher than some passively managed ETFs. These fees can eat into potential returns, so consider the cost-benefit relationship before investing. Transaction costs. Frequent buying and selling of SVOL within a portfolio can incur transaction costs, further impacting potential returns. Investment suitability. Risk tolerance. SVOL is best suited for investors with a high tolerance for risk. Its inherent volatility can lead to substantial losses, and investors with a conservative approach might be better suited for less volatile investment options. Investment horizon. SVOL is not ideal for short-term investment horizons. Option strategies can be sensitive to short-term market movements, and SVOL's performance might not be consistent over brief periods. Consider a long-term investment horizon to potentially weather market fluctuations and benefit from its long-term strategy. Investment knowledge. SVOL requires a fundamental understanding of options and their associated risks. Investors unfamiliar with options or lacking the time and resources to research and understand the complexities of SVOL strategies might be better off with simpler investment vehicles. Additional considerations. Liquidity. While SVOL trades on a major exchange, NYSE Arca, its trading volume might be lower compared to some widely traded ETFs. This can lead to liquidity risk, making it potentially challenging to buy or sell shares at the desired price, especially during periods of significant market volatility. Tax implications. The income generated by SVOL through option premiums might be subject to different tax treatment compared to traditional investments like dividends or capital gains. Consulting tax advisors is crucial to understand the potential tax implications of investing in SVOL and how it might impact your overall tax liability. Alright, folks, that's all we have for SVOL today. Remember, this is just a starting point. Before making any investment decisions, do your own thorough research, understand your risk tolerance, and consult with a financial advisor to see if SVOL aligns with your individual financial goals. Thanks for watching. We'll see you on the next one.